for that, folks. I'm sorry. Jamal is also a past vice president of the International Association of Black Actuaries in the IABA. Next on our list from Transamerica, we have Mike Gugig, who leads the state government relations for Transamerica and has been active in the long-term care insurance space for approximately 20 years. Prior to joining Transamerica, Mike was the general counsel of long-term care insurance for another company, and before that was in private legal practice with 2 large national law firms. During his entire career, Mike has presented long-term care insurance companies and has been asked to speak on long-term care insurance issues on numerous occasions. When Mike isn't at work, he loves spending time with his wife, Randy, and 2 adult daughters. He also enjoys baseball, and I'm sorry to inform everyone on the call today, but he is a Yankees fan, so I hope you don't hold that against him. Finally, we'll have Robert Burke speaking with us, who is the former Assistant General Counsel of the National Life Insurance Company. Bob was admitted to the Vermont bar in 1978, and following 5 years in private practice, joined the National Life Law Department in 1983, where his primary duties involve litigation management and employment law. Bob commenced work on a Guarantee Association matter in 1983 and served on the executive committees of the Maine and New Hampshire GAs, in addition to chairing the Vermont Association from 1997 to 2017. Bob was named the administrator of the Vermont Life and Health Guarantee Association upon his retirement from National Life in December of 2017. He is a graduate of Villanova University and Suffolk University Law School. So welcome to all our industry and company representatives, and I will turn it over to Jan. Thank you.
Jan, it appears that you're muted.
Okay, how's that?
Yeah, we can hear you. Thank you so much.
Okay, I apologize. I was just talking away. Okay, so again, I'm Jan Graber with the ACLI, and I'll spend just a few minutes setting the framework for the presentations that you will hear shortly from several of our member companies. From Anna's earlier presentation, it's clear that long-term care policies are not standardized. Products vary by carrier, by block of business within a carrier. There are different benefit periods, different daily benefits, different elimination periods. They come with and without inflation. Differences in where you receive care and how long you use your benefits. So these variations in long-term care products were really designed to help provide policyholders flexibility to choose the product that best fits their personal situation. At the time of purchase, the policyholder makes decisions by balancing their financial situation, the type of care they desire, and the risks that they might face. As we also heard from the Society of Actuaries regarding how long-term care policies are priced, the assumptions that are critical to pricing the product, and that how even small changes in assumptions can lead to the need for significant rate increases. So I'll spend the next few minutes just highlighting the value of long-term care coverage and the current state of the long-term care market. So next slide. Oh, sorry, you're one ahead. Yes, okay. So the value of long-term care coverage starts with recognizing the continuing and growing need for coverage. The world's population is aging at a faster rate than ever before, and people are living longer. By 2030, those 65 years of age and older will represent 21% of the population, and 70% of the individuals living past age 65 will need some form of long-term care. By 2050, up to 14 million seniors will require some type of long-term care service. So as the need for care increases, we also recognize that families can be a significant source of help for parents coping with physical or cognitive limitations. However, in our society, we're starting to see a growing physical distance between children and aging parents, and long-term care coverage can be a huge source of value to parents whose children do not live in close proximity. Long-term care continues to be the most effective and direct way for consumers to address this need without jeopardizing aspects of their financial plan. By covering long-term care services, insurers will save Medicaid over $50 billion in the coming years, which of course will reduce the financial burden for states. So we believe consumers do see the value of this coverage. Nationwide, there were over 4.5 million long-term care policies in force at the end of 2019. Carriers have paid over $117 billion in total claims over the years, and this includes nearly $12 billion in 2019 alone. So with the aging of our population, we expect this amount to grow significantly. Next slide. So focusing a little on Vermont, in Vermont alone, carriers paid almost 27 million in claims to more than 14,000 Vermont residents. For 16 years, Genworth, one of our member companies that you'll hear from shortly, has tracked the cost of long-term care services nationwide to help families understand and plan for their long-term care needs. And the chart to the right has data from that long-term care report. It shows that the annual cost in 2019 in Vermont for various types of care settings, coverage for home health care is over $62,000 a year. Community and assisted living care ranges from a little over $36,000 for adult daycare to over $64,000 for care in an assisted living facility. The most comprehensive care provided is in a nursing home, and that cost ranges from $128,000 for a semi-private room to over $135,000 a year for a private room. So this shows that the cost associated with long-term care coverage is significant, and without long-term care insurance, these costs can place a significant burden on financial security and on family caregivers. Next slide. So we've established a foundation regarding the state of the long-term care market, including recognition of the value of long-term care coverage and the growing need for services, and pricing challenges and resulting rate increases. So I'd like to shift the focus to how we as industry can help our customers that might be facing a rate increase. So our focus is truly on our customers, and we are committed to working with both regulators and consumers on options and solutions that focus on keeping coverage in place and options that would be available to help consumers mitigate a rate increase if they decided to do that. Consumers are truly at the core of our industry, and we want to protect them by ensuring that coverage they purchased is available when they need it. We're here to assist our customers throughout the life of the policy, and most importantly, at the time of claim. In our communications to policyholders, we strongly encourage them to contact us to discuss specific options that are available to them given their personal situation and their current benefit levels. Next slide. Our experience shows that the majority of policyholders, close to around 90%, elect to keep their coverage in force even in the face of a significant rate increase. But as I mentioned earlier, a key characteristic of long-term care policies is their flexibility in the design. And all of these variations in long-term care products were really designed to provide policyholders flexibility to choose the product that best fits their personal situation. So at the time of a rate increase, Policyholders need to evaluate how their current goals align with or may have changed from their goals at the time of purchase, and this evaluation might result in a policyholder making a decision to reduce their coverage. A policyholder's decision to reduce coverage might be based on affordability, but it might also be based on changes to their personal situation. Not all options will apply to all policyholders, and providing too many options in a rate increase notification letter could lead to policyholder confusion. The specific options that are offered to policyholders will vary by carrier and potentially by block of business within a carrier. So our carriers, they're the ones that know their long-term care products the best. And again, we strongly urge policyholders to contact us to discuss specific options that are available given their personal situation and their current benefit levels. Next slide. Let's see. Yeah, I thought we were on the wrong slide. I apologize. Excuse me, 1 minute. Okay, moving on to our rate increase notification letter or our consumer disclosure. So fundamental to our communication with policyholders at the time of a rate increase is to really ensure that we really clearly explain, what is happening, why it's happening, when is this going to happen, what can they do about it, and how do they take action. So included in this communication is the amount of the premium increase and key options that are available to policyholders. We also ensure that the communication encourages the policyholders to call us because other options might be available depending on their specific situation, including the offer of a contingent non-forfeiture benefit that Anna mentioned earlier. And this is just basically a paid-up policy based on premiums that have been paid in. And if this option is elected, then no additional premiums would be required. So next slide. And as I mentioned earlier, in our communications with policyholders, we strongly encourage them to contact us to discuss specific options. We spend a significant amount of time training our customer service teams. They understand that premium increases can be a financial burden, and we ensure that they fully understand our products and are available to answer any questions about coverage, rate increases, and the options that are available to them. So our ultimate goal is to ensure that our customers make informed decisions that will allow them to retain some meaningful coverage and coverage that also fits with their individual situation. So at this time, I'm going to turn it over to one of our member companies, John Lemoyne at Unum.
Great, thank you, Jan. Just testing to make sure that folks can hear me.
Yes.
Great, thank you. Good morning, everyone. And first, a thank you to the Vermont Department of Financial Regulation and Commissioner Pichek and the members of the department staff who have put this forum together today. Also, a thank you to the panelists and to those of you who are listening in. These are certainly very important issues, and we are pleased to be able to be part of this conversation. As was noted by Emily Brown, my name is John Lemoyne. I'm with Unum. I support Unum's closed block business unit. That business unit includes product lines that Unum no longer sells, and long-term care insurance is one of those product lines. I have a few slides I'd like to go through with you today. So we'll start with those. If you could advance the slide, please. This slide gives a little bit of background about Unum's history with long-term care insurance. We entered the long-term care insurance market in the late 1980s. We wrote both individual long-term care policies and group long-term care policies. And we then exited the individual long-term care market in 2009, and we exited the group long-term care market in 2012. Next slide, please. This slide will give you a sense of the size and scope of Unum's long-term care business. Nationwide, we have over 900,000 long-term care insureds. In Vermont, we have approximately 600 individual policyholders and just over 2,000 insureds who have coverage under group long-term care policies issued to Vermont employers. We take our commitment to our policyholders very seriously. We have over 180 professionals dedicated to providing customer service and administering benefits for our long-term care policyholders. Our top priority is to meet our obligations to customers, including, very importantly, paying benefits in their time of need. As a reflection of that commitment, during 2019, we paid over $480 million in long-term care benefits nationwide and over $2 million in long-term care benefits to Vermont policyholders. Next slide, please. There are several issues I'd like to review today around these long-term care considerations, starting with the pricing of Unum's long-term care policies and then Unum's rate increases, and finishing up with some consumer mitigation options. So, as a regulated insurance company, Unum has to manage our products to ensure the financial stability of our operating companies, both for the short-term horizon and for long-term sustainability. That approach is essential not just for our long-term care policyholders, but for all of our policyholders. When we issued our long-term care insurance policies, as was noted in the Society of Actuaries presentation, we used the best data available at that time, including assumptions and predictions about how future experience would develop over the life of those policies. As was also noted in the Society presentation, like many other companies, the actual experience in the years and decades since we issued our long-term care policies has turned out to be significantly different than the actuarial assumptions we used to set original prices. We are required by sound actuarial principles and insurance regulations that govern our activities to monitor and evaluate the experience of our long-term care insurance business and to take appropriate steps to support that business. The rules governing long-term care insurance premiums, which were referenced earlier today, set the standards both for insurers and for regulatory oversight, and those include standards that premiums cannot be excessive, inadequate, or unfairly discriminatory, and that benefits must be reasonable in relation to premiums paid. And again, where premiums are inadequate and where benefits aren't reasonable in relation to premiums paid due to an imbalance, as was referenced in the Society of Actuaries presentation by Mr. Bodner, in light of those circumstances, Unum continually monitors its experience as it develops over time. And as a result, we have updated our assumptions that we use to establish the reserves we hold for our long-term care policies. And again, you'll recall that reserves are the savings account concept that was referred to earlier. Those are the dollars that are set aside to pay future claims. In 2012, Unum put our long-term care insurance block of business into loss recognition status. And what that means is we do not anticipate that block to generate profits. Since 2012, since taking that action, we have strengthened the reserves, in other words, the savings account that we hold to back future long-term care claims by several billion dollars. I should also note that under actuarial principles and regulatory rules that apply to our business, we are responsible for seeking rate increases when needed based on our ongoing analysis of developing experience and trends. As a result, Unum has sought increases on its long-term care policies, both nationwide and in Vermont. And I should note that that analysis is an ongoing responsibility for us. Therefore, if our continuing review of developing experience indicates that additional increases are called for in the future, we will request those increases. For context, I would note that in 2019, the average annual premium for Unum long-term care insureds in Vermont was about $1,600 a year for individual policyholders and about $225 per year for group insureds. And we believe, as was noted earlier by Anna Van Fleet, we believe those premiums are comparable or very favorable compared to current rates in the market, and will continue to be comparable or favorable even with the rate increases we have requested. Nationwide, despite the rate increases that have been approved and put into effect, the vast majority of our policyholders have retained long-term care coverage. And we believe that shows our customers recognize the value of the protection that's provided by this coverage. Turning now to speak about the options that are available to consumers to mitigate premiums and the impact of rate increases, we realize that it is an important consideration to our customers to have the ability to change their coverage to adjust premium levels, including making those adjustments when rate increases are pending. We and the other insurers on this call today recognize the significant challenges that can be presented to our customers by these rate increases. As a result, we offer some adjustments that may help mitigate the impacts. For Unum, we offer our insureds the ability to adjust coverage features on a go-forward basis to reduce the impact of the increases. The nature and availability of those mitigation options may vary by policy form and by rate increase, and they will be explained to you if you receive a rate increase notification from Unum. We also have a dedicated customer service team that is ready and willing to assist you in understanding the options available to you if you are facing a rate increase. I should also note that my comments today are aimed at Unum's mitigation options only. Mitigation options available to you may vary by insurance company, and therefore we urge you to speak with your own insurance company if you have any questions about a pending rate increase or the mitigation options that are available to you. For Unum policyholders, the options available include such things as changing the level of covered care, or as Anna Van Fleet had referred to it, the care setting, reducing the monthly benefit, or changing elimination period. For Unum individual policyholders, the adjustment options that are available are those that are offered for that particular individual policy form. For Unum group insureds, the adjustment options available are those that are offered within the group plan under which the insured person has coverage. Unum also makes available the non-forfeiture option, which was referred to earlier, and in essence, the non-forfeiture option would apply if an individual has paid their premiums up to the date of the rate increase going into effect, and then stops paying premiums within 120 days after that date. In doing so, the policy would then be converted to non-forfeiture status, which means the policy remains in force, but has a limited benefit amount, as Anna Van Fleet mentioned, which is equal to the total amount of premiums paid in over the life of the policy. We also want to mention today that Unum is offering, with its current rate increases, is offering an additional option, which applies to individual long-term care policies that have either compound uncapped or simple uncapped inflation increases on the policy. And that option is called a landing spot. The option applies to individual LTC policies that have either 5% compound uncapped inflation or 5% simple uncapped inflation adjustments added annually to the policy. For individuals with those policies who may face a rate increase, the individual can entirely offset the pending premium increase by reducing their annual inflation on a go-forward basis from the 5% level to a lower inflation rate, which may be 3%, 3.1, or 3.3, for example. That's going to depend on the particular policy form and the amount of the pending increase. But if the individual chooses to elect that landing spot, then the policyholder retains the 5% inflation increases that have already been applied to their coverage, and future increases are then applied at the lower reduced rate going forward. This landing spot has been approved by regulators in 48 states, and it's been favorably received by our policyholders. We're pleased to be able to offer this option to our Vermont policyholders that have individual policies with these inflation provisions. And we also appreciate the Vermont Department's acceptance and support of that approach as an option to be offered to those policyholders in the face of a rate increase. In closing, I do again want to acknowledge that we understand how difficult rate increases can be for our long-term care policyholders, and we are committed to continuing to serve our customers as effectively as possible by continuing to monitor and manage the financial condition of our long-term care block of business, by effectively, by offering reasonable alternatives to insureds to manage affordability and premiums on their coverages, and by providing quality service during the life of the policy, including, most importantly, being there to pay benefits at the time of claim. Thank you again for the opportunity to speak today. And at this point, I believe I will turn it over to Jamala Arland of Genworth.
Thank you, John. Good morning. My name is Jamala Arland, and I'm a Vice President and Actuary in Genworth's Long-Term Care Closed Block Business Unit. Commissioner Pichek, thank you and the Vermont Department of Financial Regulation team for holding today's virtual consumer forum and for providing Genworth and our policyholders an opportunity to discuss what's happening with our long-term care insurance policies. I'd also like to thank all the policyholders for your interest and participation. Genworth understands that your long-term care insurance coverage is important to you, so we really welcome this opportunity to participate in this forum. During this unprecedented period, Genworth understands that our ability to support, service, and protect you, our policyholders, is of absolute importance. We take this very seriously and affirm our commitment to being there for our policyholders when they need us. Genworth has been selling long-term care insurance in the state of Vermont since 1974 and currently provides coverage for approximately 4,100 Vermont policyholders and approximately 1.1 million policyholders nationwide. On this slide shown, just got some demographics of the types of benefits and a little bit of general information about our block of business in Vermont. Although Vermont is a relatively small portion of our overall block, the policies tend to have daily benefit maximums higher than the nationwide averages and a higher proportion of 5% compound inflation. So those daily benefits continue to grow annually. And as Jan Graber mentioned, based on the Genworth Cost of Care survey, the average daily cost of care in Vermont is generally higher than nationwide averages. If you could advance the slide, please. Thank you. I'd like to thank Vince Bogner for his presentation, providing information that explains why rate increases are needed. And I'd also like to thank Anna Van Fleet for her presentation, outlining the department's current review process and the department's responsibility to strike that balance between affordability for policyholders and company solvency. Genworth pursued its first rate increases in 2007 and 2010, which were generally smaller increases. In 2012, Genworth pursued its first large rate increase. In 2014, after more significant levels of claims data were available, Genworth did a deeper dive on our long-term care assumptions and determined that significant adjustments were needed. Accordingly, following that review, we made very large increases to reserves and developed a multi-year rate action plan to pursue significant rate increases over the course of 6 to 9 years, beginning in 2017. The objective of the multi-year rate action plan for the pre-PCS through Choice 1 is to get closer to a break-even point. This plan has remained largely unchanged, and the rate increases continue to be pursued. We will not make money on these policies, and as such, we are absorbing a significant share in the cost that results from the deteriorating claim experience. On the Choice 2 product series, Genworth will continue to pursue additional rate increases to maintain profitability on that block. Genworth also discontinued sales of new long-term care insurance policies in Vermont in 2013 as we sought premium levels in our legacy products to keep pace with the emerging experience. If you could advance the slide, please. Thank you. The industry remains committed to working with the Vermont Department of Financial Regulation to implement actuarially justified rate increases in a reasonable and responsible manner while keeping consumer interests and concerns top of mind. As such, we believe in giving our policyholders the flexibility to make custom benefit adjustments to mitigate the impact of higher premiums resulting from rate increases, and also to find that right balance of affordability and protection for their individual situations. As Anna Van Fleet noted in her remarks, you have the choice to keep the benefits that you brought, or reduce coverage to align with your needs with a premium level that you can afford. Genworth is also providing 2 additional options you can consider when you make your choice. At Genworth, we realize that the uncertainty of future rate increases is a concern for our policyholders. To address this, for our 3 largest Inforce blocks of business, where we know we will continue to pursue significant future increases, we have developed the stable premium option, which was approved by the Vermont Department of Financial Regulation. This option is designed to have a reduced but still very meaningful set of benefits, and also provide for stability of the premium rates with a guarantee until at least 2024 or 2028, depending on the product series. Policyholders who can no longer afford or want to pay any future premium increases, or who do not otherwise qualify for an option to cease paying premiums, we voluntarily offer a non-forfeiture option that equals a paid-up policy. With this option, if the policyholder becomes claim eligible, Genworth will reimburse eligible expenses up to the amount of the premium paid by the policyholder minus any claims that have been previously paid. In addition, the policyholder will still have access to care coordination services that the company provides. So that's still a very important benefit. We understand that premium increases are a tremendous burden for our policyholders. We know this because we talk to our customers every day. Faced with a rate increase, policyholders are encouraged to reach out to us and ask for assistance in determining what their options are. We also have a website that permits policyholders to learn more about their options, and a real-time web-based tool that financial advisors can use to access information to help them explain options to policyholders. If you can advance a slide, please. Thank you. Genworth's #1 goal is to ensure our claims paying ability for our policyholders. Genworth continues to incur substantial losses on our legacy long-term care blocks. We believe that the achievement of our multi-year rate action plan is an important component in our ability to pay claims over the lifetime of these policies. Through the 3rd quarter of 2020, Genworth has paid over 300,000 claims, totaling almost $22 billion to our policyholders nationwide. For the same time period, Genworth has paid approximately $69 million to 879 Vermont policyholders for eligible long-term care benefits. We are committed to maintaining our claims paying ability and keeping our promises to policyholders, but that also requires actuarially based premium rate increases or equivalent policy adjustments that will enable the premiums to cover the claims. Genworth has no intention of taking dividends out of the Genworth Life Insurance Company. We're also in the process of being acquired by China Oceanwide, a privately held company based in Beijing, China. Upon finalization of the acquisition, Genworth will continue to operate as a standalone subsidiary of Oceanwide, with our existing management team continuing to lead Genworth. Policies will be serviced the same as they are today. Customer information will be protected through the use of an independent third-party service provider. If you can advance the slide, please. Thank you. The department asked that we also highlight some of the COVID-19 related considerations for the long-term care insurance industry. Given our industry, we are uniquely positioned to understand the devastating impacts of COVID-19 on some of the most vulnerable of our communities, and that's older adults. Considering our average claimant is in their early 80s, we appreciate that this particular population is at high risk for contracting and suffering serious effects of the coronavirus. Genworth implemented a comprehensive COVID-19 community outreach plan to assist those most challenged in our communities. We initiated outreach to local nursing homes and assisted living facilities and created a program to respond to social isolation among seniors. In addition, the Genworth Foundation has made contributions to safety net organizations in the communities in which we have offices, many of which provide care and services to the elderly. As a global organization, Genworth has created and maintained business continuity plans across all of our businesses. Despite the changes we have made to our operations in light of COVID-19, careful planning has allowed us to continue the operations of critical function, including policy administration, and most importantly, payment of policyholder claims. We've also taken measures to extend grace periods for policyholders who face hardships paying their premiums and have been more flexible in accommodating unique situations for eligible claims while continuing the appropriate scrutiny to prevent fraud. Other carriers have taken similar measures and have spoken about them on their respective earnings calls. Overall, the industry has observed what is believed to be a temporary decrease in new claims, potentially due to reluctance of insureds moving to facilities and also receiving outside care in their homes. Long-term care is a very long-term product, and we project premiums and claims well over a 60-year period. Events in any given year, while certainly tragic, are unlikely to materially change the overall projections in the future. Thank you for your attention. And Commissioner Pieciak, Genworth appreciates the opportunity to participate in today's forum. And I'll now turn it over to Mike Gugic from Transamerica.
Thank you, Jamala, very much. Can folks hear me okay? Someone say yes, please.
Yes.
Okay, thank you. Otherwise, I was going to be in a lot of trouble. Thank you very much, Jamala, and thank you to the department for inviting Transamerica. As Emily noted earlier, I lead state government relations for Transamerica and have had a pretty long career representing and working for long-term care carriers. Let me first thank Commissioner Pieciak, Emily, Anna, Pat, Wyatt, and others in the department who have worked so hard to put this session together. It looks like it's just getting everybody on a call. It's not. A lot of work goes into this, and kudos to the commissioner and his team for getting this done. These types of sessions are critical. Education of our policyholders is one of the most important things that we can do. So we very much appreciate being invited to speak during this session and to answer any questions that policyholders of Transamerica or anybody else listening might have regarding long-term care. Transamerica, for sure, your regulators and the long-term care insurance industry generally understands how challenging rate increases can be for our policyholders. This is why, as Anna explained, Vermont requires phased in large increases over a period of years. It is also why we at Transamerica and the industry more broadly are working so hard and using so much effort to find consumer-centric ways for policyholders to avoid all or part of rate increases that may be coming, while still ensuring that there is meaningful, significant benefits available when the time comes. As others have said, the critical issue is to make sure that your carriers are there when your time comes to need the benefits that you purchased. A little bit about who is Transamerica. We are a company that helps our customers guard against financial risk. So here, think life insurance and the like, to build financial security through retirement plans and annuities, and also to create successful retirements more generally. We market life insurance, annuities, retirement plans, supplemental health insurance, things like critical illness or specific disease coverage, of course, long-term care, as well as mutual funds and related investment products. Transamerica, I believe it was Vince or somebody earlier talked about the dearth of long-term care insurance carriers who are still in the market selling individual standalone products. Transamerica is one of those few companies that continues to be in the standalone long-term care business. We also market, as do many other carriers, combination products. So these are products, unlike standalone, where the only benefits relate to long-term care. Combination products are life insurance products generally, or annuity contracts that have riders on them that are designed to help cover long-term care expenses when they develop. Our presence in the United States, as of the end of 2019, we had almost 8,500 employees in the U.S. Our foundation gave total donations of $7.2 million, very much in the communities in which we have a significant presence, and also in education matters as well. In 2019 alone, Transamerica invested almost $60 million in affordable housing. We had, as of the end of 2019, 8.5 million insurance customers, over $3 trillion of insurance in force, 6.1 billion in life insurance and annuity benefits paid in 2019 alone, and 1.3 billion in health benefits paid during 2019, and that includes LTC benefits. On the retirement side, Transamerica has about 8.5 million retirement plan participants nationally, a little over 30,000 retirement plans administered nationally for those 8.5 million participants, and about $216 billion in assets under management in connection with retirement plans. So that's our spotlight nationally. If we could forward the slide, please. In Vermont, I'll quickly go through this. Again, all of this is as of 12/31/19. We have a total of almost 8,000 Vermont insureds. That is all types of insurance, not just long-term care. We've got $3.7 billion in insurance in force for Vermont citizens, $7.4 million in life and annuity benefits paid to Vermonters in 2019, and almost $2 million in health and LTC benefits, 1.2 of which was LTC during 2019. Our LTC statistics, we've got 529 long-term care policyholders in Vermont. And I made a mistake on this slide. We've paid a total of $10.1 million in benefits to Vermont policyholders to date. That was not solely in 2019. That was the 1.2 million. Retirement plan statistics, we have 803 Vermont-based retirement plans for Vermont employers, almost 12,000 Vermonters in retirement plans that are administered by Transamerica, and about $300 million in assets under management for our Vermont retirement customers. Low-income housing investments in Vermont in 2019 alone was about $3 million. So that provides a little bit of overview of Transamerica's national presence and Transamerica's presence in Vermont. If we could go to the next slide, please. We tried to differentiate between the presentations that each of the companies were going to make so it didn't get too repetitive. I do apologize. A little bit of what I'm going to say here you've heard before, particularly that first bullet up top. But we do think it's important to walk through, make sure that all policyholders understand what their options are, and then we'll go a little bit deeper into the specialized customer service training and groups that we've got. So as John Lemoyne discussed, Unum has a landing spot. We too use a landing spot that is very much along the lines that John described. There are many different unique, company-specific benefit reduction options that policyholders can access. As Jamala explained, Genworth has the stable premium option. We've got a landing spot, and Unum has a landing spot. And you should pay close attention to the communications that you receive from your insurance companies, because all companies are not created equal. And there's going to be, although some of the benefit reduction options are uniform from company to company, many are not. So I encourage you to please contact your company, make sure that you understand what your options are. Go out and get as much advice as you possibly can from trusted advisors, family members, financial advisors, attorneys. Make use of all of the third parties out there to help you make the right decision about whether to pay the full increase and keep your benefits as they are, utilize one of these benefit reduction options that will reduce benefits but still provide meaningful coverage, or take some other action. As Anna said during her presentation, the overwhelming majority of our long-term care policyholders at Transamerica, and I think it's fair for me to say this on an industry-wide basis, the overwhelming majority of policyholders keep their current benefit levels and pay the increase. And if you're in a position to do that, for the reasons that Anna explained, that is most likely the best decision that you can make. You can always go in, not only in connection with a rate increase, but particularly in connection with a rate increase. You can sort of do what I'll call the bread and butter, the non-unique types of benefit reduction options that have been spoken about before. Extend the elimination period, essentially increase the deductible if you're thinking about sort of typical health insurance. Reduce your daily benefits, reduce your maximum benefit period, adjust your inflation protection. Those kinds of things can generally be done all the time. And they certainly are done in connection with a rate increase and trying to mitigate a rate increase. What I'd like to focus on now is the customer service team that we at Transamerica have put together to give you an understanding of the information to which you would have access if you've got questions about a long-term care rate increase. By the way, I think, again, it is fair to say that most companies have these specialized customer service departments, and certainly people who are well trained in long-term care issues. So I don't think what I'm about to say is unique to Transamerica, but obviously there are some unique aspects to it. We've got a special section of our customer service team that is exclusively devoted to helping our long-term care policyholders and their families to work through sort of ordinary customer service issues, but particularly rate increase customer service issues and the mitigation options that you might have. The team is not just trained on sort of ordinary customer service duties and responsibilities, but they are specially trained to work with our long-term care policyholders. And we understand very well that many of our policyholders are elderly, might have challenges in understanding the options that they've got. And again, our customer service team is highly trained to deal with our policyholders at all levels of knowledge and experience. So I cannot encourage you more to take advantage of our customer service team in the face of a rate increase. One important thing to note, and I think Anna said this as she was going through the department team and the work that the department does to help policyholders get information. Only licensed insurance producers are permitted to actually make recommendations about how you should adjust your insurance policy. Our customer service team members are not permitted to make recommendations about what might be best for any particular policyholder, but they are able to walk through each option in depth, explain those options to you, how they will affect your policy, ultimately what the premiums would be, how your premiums would be affected, and they can go through all kinds of options with you, from A to Z, and we'll spend as much time as is needed to make sure that our policyholders understand their options completely and are in a position to make the best decision they can for themselves. The other thing that I would encourage people to do is when they call customer service, you may very well want to have a family member on the phone. You might want to have your financial advisor or your insurance agent on the phone. We would only be able to speak with them, obviously, if our policyholder is on the phone as well, but typically policyholders can invite family members, advisors, other people they trust to participate in the telephone call. We do encourage you to do that. More smart minds around the table when people are making decisions seems to lead to better decisions, at least logically it does. So I would encourage you to involve the people closest to you to help you walk through some of the decisions that you're going to need to make. Finally, on customer service, we, as Genworth said, also have a website that is devoted exclusively to rate increase issues. It is an interactive website. Our policyholders and frequently their family members can log in to the website, see policy-specific information for the particular policyholder, and then go through and toggle various rate increase mitigation options that might be available to you from Transamerica. So you'll be able to click on a particular option, see what that will do to your benefits in real time, see what that would do to your premiums in real time, so you can play with a number of different options to see what might be best for you. Also, like the Genworth website, our website has a cost of care information on it by state. So as our policyholders are considering the amount of long-term care coverage that they need, they will have access on the website to see in their state or any other state that they might be thinking of retiring in, how much long-term care services cost generally in those states. So again, we try very hard to make a very challenging situation as easy as possible to get through. We understand it will never be easy, but we are just trying to make it as smooth as we can for you. One extra point that I'll raise, I didn't throw in the slides, but Jamala at the end when she talked about COVID reminded me of this. Transamerica has made accommodations for many of our policyholders who have been affected by COVID. We have offered extended grace periods if people are unable to pay premiums. We have loosened up some of the requirements on the claims side because things like original if we were talking about life insurance, original death certificates, which are typically required in order to have a life insurance claim paid, it has been just difficult to impossible to get an original of those kinds of documents. So copies are allowed. I would again encourage you, if you are suffering from COVID, if you have a financial impact from COVID, call your carrier, call Transamerica, see if there's anything that might be available to you to help alleviate some of the financial stress that you're facing due to COVID. And with that, I think my job is to pass the baton over to Bob Burke.
Thank you, Mike. Good afternoon, everyone. Thank you for this opportunity to talk about the Guarantee Association and the the protections it provides to long-term care policyholders. I'd like to particularly thank Commissioner Pichek, Emily Brown, and Anna Fleet, and then everyone at the department who's been involved in this forum. As part of my presentation, I'd like to both tell you about the history of the association and a recent experience that we have had and the industry has had, and all guarantee associations have had, with a major insolvency, that being the Penn Treaty insolvency. Next slide, please. The Vermont Life and Health Insurance Guarantee Association was created by an act of the legislature in 1972. Its purpose is to protect policyholders against the failure of performance of contractual obligations due to the impairment or insolvency of an insurer issuing policies. In that regard, it's analogous to the FDIC, but insurance being on a statewide basis, this is done, or regulation on a statewide basis, this is done in individual states. Vermont was one of the first states to enact this legislation. And it is an association of insurers that was created to enable the guarantee of insurance payments and the continuation of coverage. It functions by assessing its members to carry out these obligations. Members are insurers who are licensed to do business in the state of Vermont. There are 4 types of policies we cover: life insurance policies, annuities, unallocated annuities, and health insurance. Long-term care policies are health policies, so anything involving it takes place within the health account. Next slide, please. Generally, the Guarantee Association protects the policies of Vermont residents who were issued a policy by a member insurer. Now, the protection of member insurers it will provide will be a member insurer who has some financial problems, but has been licensed by the Department of Financial Regulation and its policies approved by the Department of Financial Regulation, so that it received permission to issue these policies. There are 2 definitions that are important. First, an impaired insurer is a member insurer placed under an order of rehabilitation or conservation by a court of competent jurisdiction. And secondly, an insolvent insurer is a member insurer placed under an order of liquidation with a finding of insolvency by a court of competent jurisdiction as well. So before you're going to be an insolvent insurer, you've probably been an impaired insurer and would have been on a radar screen. There would have been a rehabilitation, and if that is unsuccessful, then there would be a liquidation. For example, Penn Treaty, that we're going to talk about in a little more depth, is being liquidated, or was liquidated, in the state of Pennsylvania, which was the domicile state of Penn Treaty and its subsidiary American Network, both of whom were admitted in Vermont, but were domiciled companies in Pennsylvania. And lastly, the Guarantee Association is under the supervision of the Commissioner of the Department of Financial Regulation. Next slide, please. What do we do? Well, our powers and duties are defined by statutes, most importantly, or by the statute. most importantly, if we have an impaired insurer, the Guarantee Association may guarantee, assume, or reinsure contractual obligations of the impaired insurer. If we have an insolvent insurer, then the Guarantee Association shall guarantee, assume, or reinsure the contracts or assume payments or provide funds to discharge the association's duties. Limits of coverage and assessments. For long-term care insurance, the limit of liability is either the lesser of the contractual obligation or $300,000. So if the contractual obligation is $150,000, that would be the limit of liability. We would meet that obligation. If it is above $300,000, our liability is cut off by statute at $300,000. So where do we get our money? Funds to meet a Guarantee Association's obligations are raised by assessments upon member insurers based upon the total amount of premiums received in Vermont on insurance in the account for the year premium data is used to make assessments. So specifically for long-term care, that would be the health account. So any health insurance premiums, which would include other types of insurance other than LTC, would be available for this assessment. And assessments are made in the proportion that the premiums received on business in Vermont by each assessed insurer on policies covered by each account bears to such premiums received on business in this state by all assessed member insurers. Said another way, if a company issued 20% of the health insurance in the state of Vermont, then it would be assessed for 20% of the funds needed to fulfill the obligation of the Guarantee Association. For long-term care, members who received health insurance premiums may be assessed in an amount not to exceed 2% of the amount of premiums received for health insurance for the year premium data is used for the assessment. So we're somewhat limited in the amount of money that we can raise. It is basically 2% of all the health premiums in the year that precedes the insolvency. And why the year that precedes the insolvency? Well, the Guarantee Association's plan of operation uses that premium data when it is going to assess to meet its obligations. Next slide, please. Now, I'd like to talk about a recent experience we've had with an LTC carrier that was liquidated. And I think it's helpful to see how this played out, to see both how a company's situation can deteriorate and the massive amount of money that may be needed to bail a company out. In the 37.5 years now that I've been involved in Guarantee Association work, this is the most significant insolvency that I have seen in Vermont in the health account. Penn Treaty and American Network had a large market share in Vermont and across the country of long-term care coverage. One could call what I'm going to talk about sort of like the anatomy of an insolvency and a liquidation. It was licensed in 49 states, including Vermont. It was licensed in all states, I think, except New York. And in 2001, its capital and surplus were below a regulatory action level. So it was on the radar screen as early as December of 2001. And in April of 2009, it was placed in rehabilitation by the Pennsylvania Insurance Commissioner, who requested liquidation from a Pennsylvania court in October of 2009. So 8 years after it was on the radar screen. In June of 2009, an independent actuary opined that its reserves, Penn Treaty and ANIC's reserves, were $1.3 billion negative. However, Penn Treaty and ANIC objected to the liquidation. They wanted to rehabilitate. And in May of 2012, a Pennsylvania court denied liquidation and ordered rehabilitation. Next slide, please. So litigation continued in the appeals court. It went to the Pennsylvania Supreme Court, who said the the trial court had made a mistake. It applied the wrong standard in not liquidating Penn Treaty. However, it didn't immediately liquidate. It sent the case back to the court to decide what would happen, consistent with what the court's opinion was. That started some negotiations which involved many parties, including Penn Treaty shareholders, Penn Treaty itself, the company, and NOLGA, which is the National Organization of Life and Health Insurance Guarantee Associations. And eventually a settlement was made late in 2016. NOLGA, of which the Vermont Association is a member, allows an individual guarantee association to have a little more bargaining power by joining, although not on a formal basis, but an informal basis, with other guarantee associations who have similar interests, in this case, needing to provide relief to policyholders in its state. So eventually a liquidation order was made in March of 2017, and this was almost 8 years after rehabilitation commenced. And as you can see, during this period of time, policyholders still received their benefits, but the financial condition of Penn Treaty and ANIC continued to deteriorate as its assets were depleted. So that settlement included the creation of a company called LTC Reinsurance PCC in April of 2017. That is a captive insurance established by the state GAs, and Vermont Guarantee Association participated in this settlement, but this enabled them to meet their obligation. And what LTC Re does is it manages the assets and oversees the administration of covered policies of Penn Treaty and ANIC. And in April of 2017, state guarantee associations commenced assessments to fund these obligations. And by December of 2019, the liabilities to meet these obligations were $2.69 million. So how did Vermont meet this obligation? Well, it funded it through LTC Re. The total liability needed for the Vermont Guarantee Association meet its obligation to Vermont resident policyholders was approximately $9 million. So we immediately, in March of 2017, made an assessment of $5 million. That was the maximum assessment we could make. It is 2% of the health insurance premium base in 2015, which was the year we used for the assessment. And then we made a second assessment in January 2018, as soon as we had funds available again. So we fully funded our obligation at that time, and we expect not to need to infuse additional funds to meet this obligation. Currently, there are 152 Vermont resident policyholders whose policies are administered through this arrangement and whose policies are protected through this arrangement. I think we started with about 200 policyholders in 2017, but this is whittled down through time over the last 3.5 years. And lastly, I'd just like to emphasize again, even if a policy exceeds $300,000, that is the maximum benefit that a policyholder will be eligible for through the Guarantee Association protection. Thank you.
Okay, well, thank you so much for that, Bob. We really appreciate it. And we do have one question that has come in for you. How would a consumer know if their carrier is in financial trouble?
That's a good question. It is possible they may not, but the best way to find out, there are rating agencies that rate carriers. BESS is probably the best known one with insurance companies, but also S&P and Moody's rate financial obligations. If there is contact with an insurance agent, they may know something. Also, a simple Google search about your company may tell you something. But if you're not seeing anything, the Department of Financial Regulation, I think their consumer people would also be able to answer such a question if it is brought to their attention as to what public information might be available about a company's financial situation.
Okay, thank you very much, Bob. I appreciate that. And at this point, we're going to thank again all of our presenters, and we're going to close our question and answer session there. And I'm going to turn it over for closing remarks to Kevin Gaffney, our Deputy Insurance Commissioner. Kevin?
Thank you, Pat, and thanks everyone for participating and listening in on this important forum. I want to pay a special thanks to our guest presenters who not only put a lot of work and commitment in today's forum, but there was a lot of, as Michael talked about, a lot of preparation work done to make this, I think, a very effective forum. In particular, I want to thank, I think the flow of the forum was great. I think it was with purpose, and certainly there's much smarter people than myself that put this together in this fashion. But I think the foundational presentation by Vince Bodner with the Society of Actuary kind of perspective and giving us the basics of long-term care was very helpful, followed by Anna Van Fleet from the insurance division's presentation on how we deal with these. And then I really thought the industry presenters, Jan Graber from ACLI, John Lemoyne from Unum, Jamala Arlen from Genworth, and Michael Gugig from Transamerica really gave you some insights into how not only the companies are dealing with this, but how they are interacting with the department to address a very challenging issue. And finally, with Bob Burke from the Guarantee Association that we just heard. Certainly being last in that lineup, I think, was with purpose. The whole goal here is to educate, react to the issue, and hopefully avoid having to access the safety net of the Guarantee Association. I also want to thank Commissioner Pieciak. He opened this program this morning talking about the key tenets of insurance regulation, that balance of consumer protection and maintaining solvency and making sure that carriers can deliver on their promise. And I just want to thank him for his leadership with DFR's approach to addressing this complex problem. I think part of that consumer protection piece was teased out today in the presentation. I think one of the things we want to do is make sure not only that consumers and affordability is addressed and try to give consumers options, but also that there's transparency in the process. So I think you saw that today, that there's multiple touch points and notifications that consumers will receive. The department's very involved in those communications to make sure they're as clear as they can in delivering a rather complex message. So we understand that consumers may have more questions after today's presentation. So the beauty of this is that we're recording this presentation, and we'll put an edited version on our website for people to access. But I guess I foresee even a more active utilization of this program. We continue to do outreach at the department to consumers, so we can certainly use this program and weave the components of this program into future outreach activities for Vermont consumers. And lastly, I'd just like to thank our department staff. You know, the run of the show today with Wyatt Shea and Pat Murray and Emily Brown and Anna Van Fleet, but there were a number of other folks working in the background, including Brenda Clark, Stephanie Bracken, and Jamie Giles. So I want to thank you all, and I apologize if I left anybody out. But I guess you see a little window into my world and why getting up every day to go to work at DFR is a pleasure to work with such great people. So again, thank you for participating, and we look forward to answering your questions in the future. As you see on the screen, there are access points. You can reach us by phone or email, And certainly we will give you access to all the presenters today should you have direct questions about your policies. So again, thank you for participating, and we look forward to working with you in the future. And I'll hand it back over to Pat.